What's up guys, my name is Nick and welcome to my channel. Today we're going to take a look at vertical spreads. Since the vertical spread is the most basic option spread trading strategy, it is often the first that beginners explore when moving away from outright long put and call purchases. Before I share my screen and we break it down together, please smash the like button, and if you're new to the channel, be sure to subscribe and turn on notifications so you don't miss any future content. With that said, enjoy the video and I'll see you on the other side. Cheers. A vertical spread is a combination of a long and short option of the same type with different strikes but with the same expiration date. We are trading two options at once, but we can combine these in a single trade called a vertical spread. We can buy or sell this spread as an opening trade. When we buy the spread, the long option we purchase is more expensive than the short option that we sell. For this reason, the trade is established for a net cost, or what is known as a debit. When we sell the spread, the short option we write is more expensive than the option that we purchase. For this reason, the trade is established for a net credit. These different types of vertical spreads then are known as debit or credit spreads depending on which option is bought or sold. Let's take a look at the credit spread first. In a past video, I've covered the concepts of theta and time decay. As an option seller then, the passage of time can help our position as expiration draws closer and an option's extrinsic value decays. Recall that if an option is out of the money at expiration, it will ultimately expire worthless. Take a look at the following example. XYZ stock is trading at $100 per share. We don't know where this stock will go exactly, but we are prepared to bet the price will remain above $95 over the next 1 month period. Let's sell the 95 put then, which expires in 30 days time for say $3 an option. So if this put option remains out of the money and the stock stays above $95 a share, then we get to keep this $300 net credit received from the sale of the put. It's our profit from the trade. However, there are a couple of problems with this strategy that do stop many traders from taking on short premium positions. Firstly, when selling naked options, our risk is undefined. While this is not strictly true for puts, the potential downside is still extremely large relative to the credit received. The stock could potentially crash, the company go under, and the stock price hits zero. Our losses are potentially extremely high and uncapped in the case of a short call sale, since there is no defined upside limit to the price of a stock. Secondly, the margin or capital requirement to open this trade could be very large and therefore prohibitively expensive in small and medium-sized accounts. So, what can we do to solve these two problems? Okay, so instead of just selling the 95 put, let's also buy the 90 strike put for just $1. By doing so, we have created a short vertical put spread. Note that the spread now means that the margin or capital requirement for the trade is now lower and the risk associated with the trade is now defined. Let's take a look at exactly how this trade would work. In scenario 1, the stock remains above $95 a share by the expiration date. In this case, both of the put options will expire out of the money and so will be worthless and have no value. That means that we make $300 on the short 95 put sale, but we lose $100 on the long 90 put. So our net profit then is the difference, or $200. In this case, we don't have to do anything to close out the trade. We can allow both options to expire and the position will simply disappear from our account. Or if you prefer, you can close the trade earlier anytime prior to expiration by buying the spread back and taking your profit. The second scenario involves a significant decline in the stock price. As unlikely as it may be, let's assume the stock crashes to just $50 a share by the expiration date. Let's break it down and see what the value of each option would now be. The $95 put is $45 in the money, so clearly it'll be worth $45. If we had sold this put naked, that would mean the losses on this short option would total $4,200. That's the $4,500 the option is now worth, less the $3 premium we received for its sale for a net loss of $4,200. Luckily, we also bought the 90 put, which is now $40 in the money. Since we paid $1 for this option, our total profit on the long put is $3,900. Our net loss then is just $300. Note the actual level of the stock isn't important as long as both options are in the money and the stock is trading below the $90 strike. The maximum loss of this position is $300. We can calculate our maximum loss as follows. We take the difference between the short and the long strikes, in this case $5. Note that the width of the strike is the absolute maximum a vertical spread can ever be worth. Since we sold the spread for $2, we take this away from the spread width and what remains is our maximum loss. So the last scenario, what if the stock is somewhere between the short and the long strikes, above $90 but below $95 a share? Well, it depends. The $90 put is out of the money, so this option has no value and is worth zero. The 95 put, on the other hand, is in the money. Its value will be the difference between the strike price and the current stock price. Let's take a look with the stock trading at $94 a share. The 95 put then will be worth $1, as will the overall spread since the 90 put is worth zero. Since we sold the spread for a net premium of $2, the net profit on the trade is $100. So even though the stock was below the short put strike, we still made money. So where is our break even? Well, our break even is the difference between the short option strike, in this case $95, and the net premium received from the sale of the spread, or $2. Our break even then on this particular trade is at $93 per share. Let's just summarize and recap what we have covered so far. Take a look at the following chart. It shows the stock price from left to right on the x-axis and profit and loss on the y-axis. The blue line then plots the associated vertical spread profit or loss at each stock price. When we sell a vertical spread, our maximum profit is the net credit received from selling that spread. In this example then, our maximum potential profit is $2 per spread, or $200. Our maximum loss is the strike width less the net credit received from selling the spread, or $300. This is also the margin or capital requirement for the trade. Finally, our break even is our short strike less the net premium received, or $93. Given that our loss is larger than our potential return, you might be wondering why anyone would take on a trade like this. The reason is that the probability of making this smaller amount of $200 is much higher than that of our worst case scenario, which is the maximum loss of $300. So much better than 50-50 bet, with the odds of success tipped in our favour. By carefully choosing the short strike of the spread, an option trader can choose a trade-off between net premium received and probability of profit that suit his risk-reward criteria. There is no one best solution. There is a direct trade-off between risk and reward. As we have seen then, a short put vertical is a bullish to neutral strategy that makes the maximum profit when the stock remains above our short put strike at the expiration date. Our break-even price on this trade is a little below the short put strike and depends on the net credit we receive from selling the vertical spread. Similar principles also apply when building short vertical spreads with calls. When we sell a call vertical though, we sell the lower strike call and we are hoping the stock remains below rather than above the short strike. When selling vertical spreads, we need to ensure that we are selling the more expensive option, as this means the trade is open for a net credit. If you made it this far, you made it to the end, and your support is very much appreciated. Thank you. Again, if you enjoyed the content, please do me a huge favour. Hit the like button, subscribe to the channel. Until the next time, guys, take it easy. Cheers.